Good morning, everyone. Thank you for joining our Nedgroup Investments Stable Fund update for Q1. During these difficult times, we want to support and equip you to proactively manage your clients' concerns. This telecon will be recorded and the replay will be made available to those clients who were unable to join us. We have shared the presentation slides with all participants before this call and will refer to these as we go along. Please note that we will feature a live Q&A during this call. Please type your questions into the dialog box shown on your screen. We will endeavor to address as many of these as possible during the last 10 minutes. Topics for today include Q1 performance review, current positioning, and outlook for the rest of the year. This morning, we have Nick Balkin, Portfolio Manager of the fund, calling in from Cape Town. Good morning, Nick, and thanks very much for joining us.
Morning. So it seems, morning everyone, it seems from chatting to Anil that the Skype presentation has gone on strike. It's fairly normal to deal with surprises in this environment. I think we're getting used to them. So as Anil said in the opening, I think they have distributed the presentation to everyone. I think they are working on putting the presentation up, but I'll run with it and refer to slides as I go. So hopefully everyone has the presentation open. So as I said at the open, we absolutely do live in unprecedented times. And only in the last day we've been reminded how unprecedented those times are, to see that the West Texas oil futures index traded down. Initially I got a fright when I saw it trading at zero, but it moved down to minus $40, and it's just something crazy to comprehend. I'm more than happy to take questions why that happened, but to see a number like that is absolutely unprecedented in global history. We've seen a lot of numbers, and when you own a share, you can only lose as much down to zero. And we're finding sometimes you can lose more than zero in some of your investments, so be careful. Another interesting stat to open with is this is the fastest bear market in history. It took 20 days for the S&P to fall more than 20%, which classes it a bear market. In the global financial crisis, it took 274 days. So the speed and the ferocity of the sell-off, I don't think, has truly settled in, and most people haven't truly even had their first paycheck post being in lockdown. So I think there's a lot to consider and a lot to sink in that most people are actually not really considering just yet. Another interesting anecdote, and I think anecdotes are important in this world, the Singapore office that we have obviously is at the forefront of watching what's going on with the coronavirus. We've seen what's happened there is, although they initially had a really good go at it and cut the virus off, we've seen an unprecedented pickup again in the viruses in Singapore. So that's another interesting thing, and there are many things. I don't want to swamp you with detail on the virus, but interesting that it's very hard, and most people don't understand how hard it is to truly get rid of the virus. So we think it will be around for much longer than people are even thinking, and I think one of the key things is the borders will remain closed for a long time as countries try and protect their own borders if they get it under control. And as a country like South Africa, which has quite a big tourism industry, it obviously has impacts on that. Turning to, I guess, last night's information and preempting any questions on the 500 billion stimulus package, there'll be a lot of questions. The simple answer, I spent a fair amount of time on the call this morning with the team, and the simple conclusion for us is it is at best a stability to a very vulnerable economy. We don't see this as a huge big jump in consumption. Yes, there is a bit of stability on the social grants, but actually the conclusion of the team was the risk is the genie is out of the box. At the crisis, never waste a crisis, there was a real chance of a few reforms. And unfortunately, like with SAA, the toing and froing, we feel like the money that might come in might delay some of the much needed longer term reforms. The question is, once you add additional money to a social grant recipient, do you think you'll be able to retract that social grant when things change? So I think that's an open and a setting the scene. I'm going to just jump to slide 2, which is just a bit of an update on the team, etc. And the business is largely stable. We know that the team is unchanged also, as you can see from the slide. And importantly, through all the last few years, when we remained cautious, and it was very hard to do, I think the key part of Ford is that we were able to maintain our philosophy, maintain our positioning, and that really did benefit our clients in the last 3 months. If I turn to the next slide, which is slide 3, I just always like to recap. We did a recent roadshow. I think Mark Townsend did the recent roadshow. We put up this slide. The slide is a PE or the S&P is the line, and the 2 green lines on the top and the bottom are obviously the 19 times PE and the 14 times PE. And what we said at the time was valuations were high. We were at the 19 times valuation. This is just before, and this was the peak of the market that Mark would have been presenting. Earnings, we said, was absolutely high, and confidence was too high. And we were saying, given all the risks out there, there wasn't enough margin for safety. And as you can see, that PE was very high. So this is just a quick update of what we said. If we turn to the next slide, slide number 4, this is another thing that we said in February. And this was about the oil, politics of oil. As the US became self-sufficient in oil, they were a big importer, as you can see, of oil, and they were no longer. And it's interesting, what came to pass was that it kind of got the Saudis into a corner, and we actually saw what they had to do. And there are many implications of this oil being down here. And one of the biggest implications is we're going to see a real problem in the subprime bond market, especially linked to the shale gas producers in the US. And we see a fair amount of defaults for the US banks on that. If we turn to slide number 5, what we said.
Apologies, everyone. We seem to have lost Nick. Just going to check with him quickly and hopefully get him back on the call as soon as possible. Please give us a few moments. Apologies, everyone. Still trying. Okay, everyone, we're just trying. We're almost there. Please bear with us a few more moments.
Can the operator just confirm that I'm being heard? Sorry, I'm not sure if I'm being heard.
Okay, Nick, we've got you now. Go ahead.
Okay.
Sorry about that. So we're on the politics of oil slide. Thanks
Okay,
to...
I just got to go back to it. I feel like this is unprecedented myself. I was waxing lyrically to myself, unfortunately, and I didn't know I was cut off. So
Okay.
we're going to have to go back.
Okay. Thanks, Nick,
okay.
and apologies to everyone on the call for that inconvenience.
Okay. Unfortunately, so I'll try and do it as quickly as possible. Absolutely, politics of oil had a big impact. We saw the unprecedented move by the Saudis, and that's something that we think is going to be a huge impact and not really thought about in detail. We think the US banks, especially the guys exposed to the shale gas environment, is going to be unprecedented in the issues that they're going to feel on the bad debts. So jumping to the next chart, what did we do about it? We absolutely said that we had optionality built into the portfolio. Within the actual fund, we had sold some Aussie futures. Within the Ford International, that is a building block of the S&P, we had the put options that reduced the equity exposure quite substantially down in Ford International, and that helped protect substantially. We also added significant, we had the significant put option, but we also had the call options on the bonds on the long duration, which we've spoken about previously. So significant optionality to protect our portfolio through tough times. And what happened? The tough times absolutely arrived. It's even when I look at this chart, it almost takes my breath away. The ferocity of the sell-off. In the last few months, we've seen the Aussie year-to-date being down more than 20%. Just in March, it was down 13.5% on its own. The S&P, as you can see, everything was down besides world bonds and gold. And in March alone, the S&P was down 13% in dollars. And I think it really is credit to the stable fund performance and positioning that it was only down 3% in that month against those substantial falls. And that didn't come by accident. It absolutely was all the preparation that we've been talking about previously. And I think it's really served our investors very well through these tougher times. I think just to get a feel for the SA Incorporated performance. Just look at the financials. They mostly SA-focused companies, down 40% year to date. That is a significant number to comprehend. Moving ahead, I have updated the PE chart that I showed you a little bit earlier. It's quite an interesting chart. You can see the two rails coming down significantly. That just shows you that the forecasted earnings per share of the S&P has come down substantially. And the PE did come down from the 19 times to 14 times, but has subsequently re-rated back up to the 19 times 1 year forward as the S&P has moved back up to the top of the rail. And what we're saying is these unprecedented times, that probably with additional earnings risk actually is probably not that cheap. So everyone's seen the sell-off, but we're saying that actually when you look at the rating, the earnings have come down commensurately. So we're not saying that this is a huge opportunity to be filling your boots with equities. If we turn to slide number 8, it is a performance chart, and I did briefly mention the stable fund's performance. As you can see, we don't usually crow about the shorter term performance. We're absolutely long-term performance focused, but when the market does sell off, it's important to show that we're doing what it said on the tin, and we're down 3% against all the other indices really struggling. But it's great to see the 10-year number. If you ask me, if I were to point out one number on this chart, would be the 10-year number where we ranked number 1, given a really solid return to our investors. And that's what we need to do, is do a lot of good things, position ourselves, and when tough times come, be able to protect. And I think it's all the more credible, the performance, in that we don't have any platinum, we don't have any gold miners, and we don't have any NASPers in the portfolio. So to have done over 10 years a number 1 performance and generated a solid return in what has been a very tough 10 years, and without any of those, has been, I think, a very credible performance. If I turn to the next slide, all I did, and for speed, I know everyone's probably, I know no one's got anywhere to go to besides the shops, but I think they might have other meetings, so I'm going to try and speed it up a little bit, is the contribution slide on slide number 9. Sorry, I forgot to keep guiding everyone to the number slide that we're on. But turning to slide number 9, the average weights of the different sector or asset classes show you where we actually accentuated our weight. So the important chart, the takeaways from this chart is to see that we had a very low weight in domestic equities, which were down substantially. We had a very big weight in interest-bearing and SA bonds, which was more resilient, especially over the year, and a big weight in foreign assets, which generated a substantial amount of performance. I think that's an important takeaway. So I'm going to jump over the next chart for speed, and all the things did tend to work over that current period. Predictable earnings on the next slide. I'm going to jump over slide number 12 to speed things up, but if you can see the stress test in March, the dot is for the Nedgroup Stable Fund performance, and you can see the dot is where we performed very credible against a high variability of other funds. Moving to the positioning, you can see it's probably better shown on another slide, but it's unchanged relative to what we've chatted, I guess, largely only a few months ago with Mark Townsend on a roadshow. High weight in bonds, full allocation to foreign. We have a low weighting to domestic equities. We continue to have a low weighting to domestic equities, and we've chosen to take the opportunity in the bond market that's offering us very good yields, making sure that we own the mid-duration. As we've said, we are more cautious on the longer duration bonds given where the South African financial system is going and the government's debt levels. And as we spoke about before, more than 5% in gold. So looking ahead, I'm just going to skip over the top 10s if that's okay. On slide number 14, you got it in your takeaway. Unchanged, biggest holding is the 186, which we've spoken about, and then the 2 global funds. The next slide is the top 10 equity holdings. I think the quick and dirty takeaway there is a lot of these companies are staple companies. FMC is a fertilizer provider. BHP is the lowest cost producer. Then we have some tech, some pharma, some staples. And a lot of the companies will continue to sell their product in good times and bad times. So I think that's the key to a defensively positioned portfolio that has served our investors very well. Last bit, Mark Townsend has taken you through this in February, so I'll just be repeating. But what I did on slide number 16 is just to show you the different economic drivers. And we've seen that instead of showing the Reg 28 positioning, we actually separated it into economic drivers. And the two biggest buckets are obviously the global growth assets, which are global focused equities, and then the bond bucket. Other than that, I think that was the quick and dirty. I really am sorry that we lost you in the middle. I'm happy to take questions to clarify any additional points.
Thanks very much, Nick. So I guess just looking at some of the questions that came in, just in terms of the USD ZAR, it hasn't really responded much this morning after last night's announcement. So it seems like a lot of the stimulus measures was kind of expected by the market, or maybe not seen as that fantastic. What are your thoughts?
Yeah, I think like with anything, the markets tend to go ahead of any news. The old saying, buy on rumor, sell on fact. And I think to a large extent there has been a significant appreciation already. One additional thing that I didn't speak about is and I think it is important to, I won't go into the specifics given the timelines, but we have added additional optionality or protection into the portfolios more recently. Because we have a fairly significant offshore weight, what we've done is a few % of the portfolio, we have bought some currency puts, and we financed that with a written call at no premium to the portfolio, so zero cost collar against a few % of the portfolio to protect against, I guess, some sudden rand appreciation if that were to happen over the next period to, I think, December is the protection. So tactically, I think the rand has done a lot, and it is due a bit of a breather. We continue to worry about the long-term trajectory and retain our long-term view that the rand will continue to weaken even from these levels. But tactically, in order to maintain our significant global equity weight, we've been able to lock in a few % of that to make sure that we protected against tactical rand appreciation. But it is a relatively small number.
Thanks, Nick. And then just in terms of the bond yields, so obviously South Africa's debt to GDP ratio is probably going to go up quite significantly from this point, but potentially yields could be looking better value going forward. What do you think?
Yeah, so I think, like I communicated, I think one of the key points is that the trajectory we're on is actually, I would guess, an unsustainable trajectory. And most of the money we're getting, whether it's the IMF or other, a lot of the reporters are saying, well, it comes at a 1% interest rate. The problem is, if I give you 5 billion rand, Anil, and I say to you, I'm only going to charge you 1%, you still have to pay me back, right? That's the biggest thing, is that we're adding to the debt burden, and the debt trajectory is on an unsustainable level. So, and a lot of the stimulus is actually going to go towards social grants, etc., maintaining people's salaries. What we've always said is, in order to get excited that there's sustainable long-term growth, which is needed to pay back this debt at the end of the day, is reform of the country and stimulus in the right places, which is infrastructure, etc., to make sure that we are, and reform of the education system and all those things. The short-term fix now is not going to cut it, unfortunately. So looking at a period after year 5, in the forecast period like we presented, that sweet spot remains in the debt of the government at 5 years and below, on a modified duration point of view, because we want our money back, and I want our investors' money back. And the risk is that this additional debt will further put at risk the long-term sustainability of the country. Having said that, we are offered 11% on the longer dated bonds, so we have a small amount. But if you're worried about the long dated bonds in South Africa, I would say you absolutely should worry about any equity. And equity is all, at least the bond has a finite date, and equity is a perpetual investment. So all those things equal, we think that the bond market below 6 years remains attractive because we have a high sense that we will get our money back and inflation will be at least partially under control over that period. Above that, we are unsure and getting less sure about.
Okay, great. Thanks very much, Nick. That's all we have time for today. We really appreciate your insights and expertise.
Yeah, no, I'm sorry everyone that the middle was cut out. I'm glad we got it back together. I'm more than happy if anyone missed a question and wants to pop me or send it via Anil to me. I'm more than happy to answer it directly.
Okay, great, wonderful. And to our valued investors on the call today, just please feel welcome to contact us if you have any additional questions or concerns. So, and just rest assured that we are available to support you and your clients during these difficult times. Thanks very much for joining us today. A reminder that we will be speaking to Omri Thomas for an update on the Nedgroup Investments Opportunity Fund tomorrow morning at 10. Best wishes for the rest of the day. We look forward to connecting with you again soon. Thanks, everyone.